All right. Good evening, everyone. Welcome to Ab India Karega Invest, an initiative of Groww to reach out to all of you every week with an interesting topic. We have been running this initiative for over a year now, and we come every Friday with a cutting edge topic, and we bring you experts of the industry to shed light on it. Today we have Mr. Siddharth Srivastava. Mr. Srivastava has more than 10 years of experience in the field of financial services and stock markets. He has been associated with Mirae Asset Investment Managers Private Limited from September 2018 till date, with overall responsibilities of leading passive investment products. Prior to this assignment, he was a senior manager at NSE Indices Limited from September 2014 to October 2018 and was associated as senior associate at Morgan Stanley Capital International from November 2010 to August 2014. And these are some stellar credentials. And today he has joined us on to talk about the topic tech giants of the East. So over to you, sir. And we're really, really looking forward to this session.
Yeah, thank you so much, Richa, for having me here, and thank you everyone for joining this session. So here I'll be talking about a new product which Mirae Asset is coming out with, and our intent on the passive side, especially, is to always come out with new, interesting thematic ideas. And previously, we have come out with a Fang Plus product, and then S&P 500 Top 50 product, and now we are uh, in process of coming out with ETF as well as a fund of fund which will track the Hang Seng Tech Index. So unlike a Fang Plus ETF and fund of fund which tracks the tech giants of US, the intent here is to track the tech giants of Greater China economy, the ones which are listed on Hong Kong Stock Exchange. Now it is up to the investor to choose the right medium. For ETF, you need a demat account. Investor who prefers to buy or sell the units on the exchange in one quantum, one share or 10 shares or 100 shares in any quantity at real time net asset value can buy or sell the ETF. People who prefer a normal mutual fund route want to, let's say, use facilities like SIPs, STPs who do not have a demat account can obviously take exposure in this portfolio through the fund of fund. Now, ETF will be directly investing in the underlying stocks, underlying 30 stocks of Hang Seng Tech Index, about which I'll be talking in the later part of the presentation. Whereas the fund of fund will be investing in the ETF itself. Both the schemes will be managed by the Mirae Asset India team. The NFO for both these schemes is already ongoing. It started on 17th of November. For the ETF, NFO closes on coming Monday, which is 29th of November. And for the fund of fund, it will close on coming Wednesday, which is first of December. So first, let's talk about why should we look eastwards, like China or Hong Kong, as an investment option. So, as we all know, especially in last 1.5 year, we have seen very serious traction among Indian investors to invest overseas, and probably US is the first step because US is more familiar market. It is the world largest equity market. It has opportunities uh, from an investment point of view in very well-known companies like Apple, Google, etc. It has also very interesting opportunities to invest in new emerging and disruptive themes like electric vehicles, artificial intelligence, cloud, etc. That is why probably the first step for an investor is to evaluate US as an investment option. The fact of the matter is, which is now getting highlighted, thankfully, is that no one country performs consistently at all times. So it is important to diversify. It is important to invest in opportunities outside India because India is just 3% of the global equity market. There are significant amount of opportunities, especially on the tech side, which is not available in Indian equity market for investments. So it is always prudent to look outside, to look in economies which are doing well, to look in markets which are doing well. And after US, after people have invested in US, they probably look for other investment options, right? Where they can diversify more, where the wealth creation opportunity lies. And one such market is China. And this you can take exposure through the Chinese companies which are listed on Hong Kong Stock Exchange, which is one of the largest exchange globally. Now let's talk about China first. We all know how well China has grown, right? It started opening up its economy in 1978. It is surprising to know that in 1960s, the Chinese per capita GDP was actually half of India. Uh, then when they contemplated, they realized that they need to open its economy, and at the start they focused on low cost manufacturing and industrialization. So from 1978 onwards, they start focusing on low cost manufacturing and industrialization, using its significant workforce to obviously to run the entire machinery, and they have been phenomenally successful in that. In last since 1980s, in last 30-40 years, China has grown at an average of 9% per annum, more than 9% per annum, and that is one of the fastest recorded pace of any large economy historically. In fact, the recently also the GDP of China has grown from 6.1 trillion in 2010 to 14.7 trillion in 2020. And just as a barometer, India's GDP is just about $3 trillion, just shy of $3 trillion. So, and China is right now the second largest economy. So they have maintained up their pace of growth significantly. In fact, by 2025, it is projected to become a $23 trillion economy, which is going to be significant. Now, I mentioned that earlier the focus was on low cost manufacturing, right, and industrialization. And typically, whenever we talk about China, we relate China with that. But something has changed in last 15 years. Is in mid 2005, China realized that they have obviously grown significantly. They have become a middle income economy. But in order to transition to a higher income economy, they need to focus on technology, because innovation, R&D expenditure, uh, creation of new technology is going to propel them towards a higher income economy. And that is why in 11th, 12th, and 13th 5 year plan, their intent shifted to promote these soft tech companies, especially to ensure that internet penetration in China increases, more people are onboarded to use the services and products which are available on platforms like internet, which obviously in a way can bridge the divide between rural and urban areas, and they have been very successful in that. For example, if you look on how they have grown, the contribution of this tech and digital economy, the one they have focused on in last 15 years, has grown from just $400 billion in 2005 to almost $5.7 trillion in 2019. The contribution of this tech and digital segment from 14% in 2005 has grown to almost 36% in 2019. So in a way, what they have achieved is they have been able to create these big tech companies, tech giants of East, which has driven these innovation, which have created these opportunities by coming out with new products and services. Companies like Baidu, Alibaba, Tencent, Meituan, JD.com have been at the forefront of innovation. They have been doing work like what FANG companies have been doing on the Western shores. They have been doing similar, if not better, work in Greater China region. And that is what and one thing which has helped them is this freedom with which CPC, uh, Chinese Communist Party, has provided, and the regulators have provided to these technology companies in last 15 years. We'll talk about the regulatory headwinds which they are facing now, but there's no denying that in last 10-15 years these companies were allowed to have their own policies and processes, which has helped them to grow significantly. Right, these right now Chinese e-commerce market is largest in the world at almost $5+ trillion. Their total internet users right now is around 989 million people, which is more than India and China put together. Almost 80% of people uses mobile payment. There are more than 750 million e-commerce users. There are almost 400 million people who order food online. So not only these companies like Baidu, Alibaba, Tencent, etc., have been able to create the products and services, but they have also been very successful in bringing the entire domestic uh, uh, people of China on the internet platform, make them use the online products and services, and they have created a very significant domestic consumption base, right? And now they are also looking outwards to capture market in other countries also, and that is why these companies have grown significantly, and the potential opportunities which they have created and even now what they are looking at is pretty significant. So this was more on the soft tech side, right? When I'm referring to soft tech, I'm talking about products like e-commerce, social media, uh, which are intangible in nature, right? Services which are intangible in nature. But now China is also focusing on hard tech, technology which creates tangible products like 5G, like Internet of Things, components which are used in obviously is networking, etc., in cloud, in EVs, in autonomous vehicles, etc. So now what China has decided is that okay, in last 15 years, I have created this entire soft tech base where I have propelled uh, my people to use internet products and services. Let me focus now on the hard tech market also, because this is where the technological advancement will happen, and this is where probably I can exert more influence on how things will work in future. So while they have created this own whole soft tech ecosystem, they are now going to focus for next 5-10 years on the hard tech segments. They have identified something which they refer to as core technology, where for next 5 years they are going to invest almost $1.4 trillion to create the hard tech ecosystem. Now we have been talking about the hard tech and the soft tech, and soft tech has grown significantly. I'm like, one thing which you can now associate China is also with R&D and innovation. For example, in 2019, almost 58% of patents were filed by Chinese companies. That is the kind of growth towards research and development, towards technological advancement, which China has taken. But recently, we know that these soft tech companies, which have grown significantly, which have created a huge domestic market of products and services, are facing headwinds, right? We know in last 9 months or 1 year, a lot of issues have cropped up on the regulatory front, right? In the start, I told said that in last 15 years, these companies were allowed to grow. Very less oversight was on these companies. They were allowed to have their own policies and practices to ensure that these tech giants are created which can compete globally, right? You need to have deep pockets, very good products and services, very good track record of innovation in order to compete with Western giants, and that is what these Baidu, Alibaba, and Tencent have been able to do now. But now what has happened is that globally there is a need to obviously to have a more oversight on companies which are involved in let's say fintech, on social media, dealing with customer data, e-commerce, etc. Right? And this we have been seeing in on the Western shores also. For example, Google has faced anti-competitive issues in Europe. Amazon and Facebook are facing issues pertaining to minimum wages, pertaining to data security, etc. In US, and same issues these companies, these big Chinese companies are facing in China, right? Because now the government wants to control. While they have incubated, while they have let these companies know, it feels that the time is now right for the greater good of the society and for the long term betterment to control the tech companies regarding how they are functioning and what their policies and processes are. There need to be better anti competitive laws so that companies are not able to exert undue influence. There needs to be better data security. There needs to be better consumer rights, more better vendor rights. There need to be better treatment of the workforce, etc. Because of which, there have been measures introduced which has surprised the market. Because if you go from a period where there were no regulations to a period where government and regulator wants to introduce a regulation, there's a shock, because Chinese government and regulator works at a different pace. They work with a ferocity which at times surprise, and in this case has surprised the investors, because of which these tech companies have corrected, soft tech companies have corrected by almost or more than 40%. Hang Seng Index itself is down by almost 40% from its recent highs, and and this is not something from an intent point of view not surprising, because when you see what China is trying to do, they are trying to do what US is trying to do with big tech companies within its border, what Europe is trying to do with global tech giants. China is also trying to do the same. But since there's an opaqueness with what China does, there's probably less clarity what its intention are. The blowback has been very significant. As I mentioned, this has been corrected by almost 40%, these soft tech companies. But having said that, now we are seeing a lot of clarity which is coming out from the regulator. For example, a new data security law was implemented in September. A new personal information protection law has been implemented from 1st November onwards. Both these laws in aggregate talks about how you need to protect customer data, how you need to secure customer data, what you can do, what you can't do. Probably there are going to be more laws which talks about how these internet companies can use algos to target customers, among other things. And these companies also have realized that they need to toe the line. They need to work for the greater good of the society, for the common prosperity, which is the go-to word uh, in China right now, in especially in 14th five-year plan. And companies have also been course correcting. They have been onboarding new compliance departments. They have been onboarding new people so that they can obviously cater to all these regulatory requirements which China has come out with. So we feel that most of the serious headwinds have passed away. There may be more clarification which may come out in near future, which will further calm the markets. While because of these new regulatory guidelines, the top line and the bottom line of the company probably will take some amount of it. But we believe once this issue has been taken care of, once we get more clarity, which we are already uh, have gotten last couple of months, we feel that this portfolio as a whole, which has corrected by almost 40%, will see some revival. Where while we are talking about the overvaluations in India, in US, and other markets, we are talking about set of soft tech companies which have corrected by more than 40%, and probably with headwinds dissipating, there are chances that that the recovery might be seen in these set of companies. Now, when I'm talking about Hang Seng Tech Index and the correction which has taken place, remember that earlier I was talking about both soft tech segment and the hard tech segment. Just to avoid confusion, soft tech is anything which is intangible products and services like e-commerce, social media, etc. Hard tech is something which is like semiconductors, 5G, tangible products, right? This portfolio consists of both soft tech and hard tech. We believe that hard tech will be benefited by the Chinese government push in these core technologies. It wants to dominate these industries like semiconductors, 5G, Internet of Things, etc. Hang Seng Tech Index has exposure to these set of companies. So one portion of the portfolio will benefit from the Chinese push in the hard tech segment, and the other segment of the portfolio, which is the soft tech, will probably benefit from more and more clarity from the Chinese regulator, and probably then the subsequent recovery of these stocks, which have, as I mentioned, taken hit because of the way or the ferocity with which a regulator came down on implementing the regulations, which are also being implemented in other parts of the world. Now, coming to the Hang Seng Index, it's really straightforward index. It consists of 30 largest tech companies which are listed on Hong Kong Stock Exchange and which are deriving their significant revenue from Greater China region. From an intent point of view, the company needs to be a tech-centric company and following at least one of the following tech themes, which is internet, mobile, fintech, cloud, e-commerce, digital, and autonomous. As soon as I say digital, the universe expands, right? So anything which caters to internet space, including mobile, fintech, cloud, e-commerce, digital, or autonomous, forms part of the portfolio, or rather is eligible for the portfolio. Then company should meet at least one of the following criteria. It should have a tech-enabled business platform, like on internet or mobile, or it should have R&D expense to sales ratio of more than 5%, or YOY revenue growth of more than 10%. Top 30 companies based on market value is selected to be part of this particular portfolio, and a stock cap of 8% is applied to ensure that there's no significant concentration risk. And see what has happened. A significant uh, I think when we talk when as an Indian investors we talk about uh, tech portfolios, at time we get biased with what there is in India. There's only typically, let's say, more IT consultancy companies. But when we talk about US, when we talk about China or other markets, the tech domain is huge, right? And you can see here, right, in Hang Seng Tech Index, you are not only getting exposure to soft tech and hard tech segments, but within soft tech and hard tech segment, you are getting a very varied amount of exposures in multiple tech domains. For example, you're getting exposure to food delivery and online travel through Mitwan, which is one of the highest holding in Hang Seng Tech Index. You are getting exposure towards e-commerce through JD.com and Alibaba, which is the top two e-commerce companies in China. You are getting exposure through to social media and online gaming through Tencent. Probably most of us know about how big and huge that company is. Then also you're getting exposure to, let's say, semiconductors through three companies: ASM Pacific Technology, SMICs. You're getting exposure towards smartphones and consumer electronics through Xiaomi, through Lenovo, through Haier. You're getting exposure to healthcare IT through JD Health, Ali Health, etc. You are getting exposure towards electric vehicles and batteries through BYD. You are getting exposure through to autonomous vehicles through Baidu. So there's a vast array of exposure which you are getting through this portfolio in different tech domains. I mean, even let's talk about Baidu. Baidu, while it is known as the Google of China, the go-to search engine in China, it has very strong presence in cloud computing, and we also be surprised to know that it has a very strong position and probably one of the first mover advantage when it comes to autonomous vehicles. And that is what these companies does, right? When we talk about FANG, when we talk about Apple and Google's and Amazon the world, we just don't correlate them to one uh, product. We talk about multiple business opportunities, multiple revenue segments, and that is what we are seeing in Hang Seng Tech also. These giants are not just present in one segment; they are present in multiple, uh, and 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 through these companies, you are getting exposure in hard tech and soft tech, and multiple tech opportunities. Just to give you a rough idea of what we are talking about, even after 40% correction, the market cap of Hang Seng Tech companies is around $1.8 trillion, which is 15% more than BSE Sensex 30 companies. Revenue is $463 billion. Cash is one around $150 billion, which is two times the cash held by Sensex 30 companies. Net income is around $45 billion, and R&D expense at $29 billion. In fact, exceeds the R&D expenses of all 500 companies put together. Now let's come to performance. I think that is one thing which we all want to look at, right? The only reason why we want to overcome our home biasness and invest in foreign markets is because we want to generate that extra wealth, right? Because if that is not the case, why will we even talk about investing outside India? And we invest in US because if you look right now from a 3 year, 5 year, 10 year point of view, US has generated more wealth than India, and that's why probably the first step is US. But even when you are looking at Hang Seng Tech Index, what we have done is we have broken down the performance in two segments. In the top part of the table, what you are seeing is pre-regulatory issues, what was happening, right? This is Feb ending data. So let's see what was happening before the regulatory issues happened, and let's see what happened after the regulatory issues, and then see what sort of opportunities exist, right? So pre-regulatory, the Hang Seng Index, you can see, was outperforming Nifty 50 by double-digit margin on a CAGR basis. So in 5 year, Hang Seng Tech gave a return of 28.2% versus 17.1% by Nifty 50. In 3 years, 23 versus 12.6%. In 2 year, it outperformed by almost 33%. In 1 year, outperformed by more than 50%. So a significant amount of wealth creation by Hang Seng Tech before the regulatory issues happened. Post that, as I mentioned, it has corrected by almost 40%. That's why we are seeing that in last 1 year, it is down by 13% compared to a 58% return by Nifty 50 index. So it has a history of wealth creation, but the recent regulatory issues has obviously given Hang Seng Tech a beating, which obviously for most of the investors who are keen may look very attractive from a valuation point of view, because we are talking about a market which is trading at around 16.8 PE based on 12-month trailing, uh, based on 12-month trailing performance, right? So whereas India we are talking about, or US we are talking about a double-digit premium, right? So there exists an opportunity in this particular portfolio from a valuation point of view. But having said that, I'll also like to point out that typically, historically, Hong Kong markets or Chinese markets have been more volatile, and hence it carries more risk than uh, India or US. So, people who have high risk appetite, people who are willing or who have the appetite to take such risks, sh- should only invest in this particular NFO, in this particular product. For example, let's see the calendar-wise return. In last 5 out of 7 calendar years, Hang Seng Tech has outperformed Nifty 50. In fact, in some of the calendars, it has outperformed significantly. In 15 by almost 20%, in 16 by almost 12%, 13 by 13% in 2017, again by almost 27% in 2019, a phenomenal 68% in 2020. But then it has taken a beating in 2018, where it gave a return of 31% negative, whereas Nifty 50 was positive 4.6%, and this year where it is down by almost 26.6%, and Nifty 50 is up by up by 27%. So there is a decent volatility in Hang Seng Tech Index, and recent months have showed that. So while it is a very interesting opportunity to take exposure in something which is right now at very attractive valuation, but only people who have high risk appetite, who can obviously, whose portfolio can obviously take such type of volatility, should only invest in this particular info. And I've already mentioned that based on 12-month trailing PE, right now it is trading at almost 38% discount. The PE is around 16.84, so makes a very interesting opportunity from an investment point of view. So I'll just summarize. The Hang Seng Tech uh, index consists of 30 companies, 30 China centric companies which are listed on Hong Kong Stock Exchange. It consists of both soft tech and hard tech companies, companies which are belonging to a very vast set of tech domain, ranging from e-commerce to social media to healthcare IT to fintech to EVs, autonomous vehicles, semiconductors, IoTs, 5G, etc. So you're getting a very good diversified exposure in the tech domain. The index is expected to evolve as Hong Kong market evolves, as more and more companies gets listed on Hong Kong. If it satisfies the index criteria, it will form part of this portfolio. And while while we have seen significant correction in the Hang Seng Tech recently, we feel that most of the headwinds have already happened, and we expect more clarity from the regulator and government, which probably should help these companies to perform better. And while, just a concluding remark, while the product had done well, very well, in fact, before the regulatory issues, in terms of calendar performance, it has outperformed in 5 out of 7 calendar years. It comes with its own set of idiosyncratic risk. So people who have good risk appetite should only invest in this portfolio. Uh, as I mentioned the very start, there's an ETF also, as well as fund of fund also, which we are coming out with. ETF NFO for ETF is closes on Monday, which is 29th of November. For the fund of fund, it closes on 1st of December, which is Wednesday. The allotment date for the ETF is 6th of December, and for the fund of fund is 8th of December. So you can choose either of the medium, whichever is more suitable to you. And uh, and 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 if this particular product matches your risk profile, you can go ahead and invest in it. So that's it from me. It's back to you, Richa.
Thank you so much, sir. I think everyone got a lot of clarity when it comes to Hang Seng Tech and just the Chinese markets in general. And obviously, there will be a bunch of questions. So, we have a fair amount of questions for you. So, let me quickly get started with that. So, the first question for you is: what is the situation of the global chip shortage? And how do we participate in companies that are involved in chips manufacturing?
Yeah, so I think that's a very broad question, probably not related to this product, but from a chip shortage point of view, I think most of us are expecting it to continue in 2022 also. And while this product gives you opportunity to participate in companies which are into semiconductors, right? There are 3 companies in this portfolio which are into semiconductors, but I think if you want to invest only in semiconductor businesses, then probably you can look for other products also, where the exposure towards such companies is on the higher side, because this is more of a diversified product which not only caters to the semiconductor, but also to the other tech opportunities.
Got it. All right. So your next question is: which countries are the major players in manufacturing blockchain and crypto mining hardware, and how do we invest in such opportunities?
So so I think that's a so I think there was a recently an NFO which was going to come on the blockchain side, and that was obviously taken back. So I think probably people have to wait if anyone comes out with a blockchain centric or a crypto centric mutual fund, which will allow the investor to take opportunities in such set of companies. But it depends, right? It depends on regulator. It depends on what government wants to do in this particular segment, and if there is an opportunity which is made available to the mutual fund industry, probably someone may come out with a fund which provides investor an opportunity to take exposure in blockchain and cryptos.
Got it. All right. So what are your views on Chinese government breakdown on big tech companies?
Yeah, so I think we covered it in detail in the presentation itself. And see,
Mm,
there are multiple ways to look at it. There's no denying the fact that when you're talking about China, there's a set of opaqueness involved. Things are not that much clear, as clear as it is when US is coming down on its own tech companies, or let's say Europe is taking action against Google's or Apple's, right? There's a procedure
mm,
and process involved, and it comes with a set of transparency. And investors anywhere does not like lack of clarity. They always prefer clarity, even if it is on the negative side. They want clarity. So that is one thing which was missing when this entire regulatory headwind started to happen. Whatever happened was not something which is happening against the big tech companies for the first time. Like in Western countries, we are seeing actions against Google, especially regarding anti-competitive practices. We are seeing issues pertaining to data security, consumer rights, minimum wages, vendor rights, etc. It's just that the ferocity, the lack of clarity surprised people. But in last 3 4 months, we are seeing lot of laws being documented by the regulators. There's a data security law which came out in September. Personal information protection law came out in November. We're expecting a couple of more clarifications from the regulator in near future. I think one thing which we should realize is that probably China has moved towards more socialist uh, behavior. In the latest 5 year plan, they are talking about common prosperity. They want to elevate the per capita income of the economy. They want to ensure that the wealth is more equally distributed, and that is probably why they want these tech companies to improve their policies and processes so that other players are also able to work. There's a more uniform distribution of wealth. Wages are paid in a better manner. There's a better protection of consumer rights, etc. I think China is very well aware that these tech companies are the ones which will drive its economy in future, be on the soft tech side or on the hard tech side. I think they are just clearing the muddy waters so that next set of growth, when it happens for these set of companies, it's probably in a more aligned manner with what Chinese government think its economy should function.
fair enough. All right. So your next question is more like your views on diversification in the Eastern markets versus the Western markets.
Yeah. So I think that's a great question. And one thing which in fact I had a data in front of me, and I like to say, so we all have our own set of biasness, right? And home biasness. So whenever we want to invest, it is our Indian markets where we invest first. And then we look at opportunities outside. Sadly, India is just 3% of the global equity market. Our market is dominated by legacy sectors. We still talk about energy, we still talk about banks, BFSI. Now, while some unicorns are getting listed, while we are talking about valuations, but still numbers are very low. So there exist a significant opportunities outside. And then, to be honest, people have uh, in last 1.5 year taken up to international investing numbers. If I'm talking about fund of funds which are investing overseas, there were 1.9 lakh folios at the end of March, and if we are looking at it right now, the folio stands at 10.5 lakh. So a
Wow.
significant amount of increase in the investors who are investing overseas.
Mm-hmm.
Now, when you're investing, the very obvious first step is US market, right? Because you are
Right.
more familiar with it. There are companies which are part of our daily life. We are using iPhones. After this, I'm probably going to surf Netflix, probably order something on Amazon, right? And these are
Right.
companies which are available in US market. People want to invest in it. That's what we saw in FANG, which we came out with. And then probably like one question you got on blockchain, you got question on cryptos. I think probably some question may be related to. We got one question on semiconductors.
Mm-hmm.
3 out of 4 questions were related to emerging and disruptive technologies, uh,
Right.
and that ecosystem is present in US. So people are investing in US for these well-known companies and
Mm-hmm.
these emerging and disruptive tech. Here, you can probably use these products to even make them part of your core portfolio. So something like S&P 500 top 50, which is a sector agnostic portfolio, can become part of your core portfolio. Here you can take exposure, let's say start with 5%, go up till 15, 20%. That is the amount of, I believe, that international exposure you can have starting from US. But as soon as, if you want to diversify more, let's say if you want to evaluate a Hong Kong market or a Taiwan market, first thing which investors should understand is that each market behaves very differently, very
Mm-hmm.
differently. I mean, they have their own set of risk and return profile. So first of all, investors should understand that whether they have that risk appetite, and then probably start uh, investing in it from a satellite portfolio point of view. So for while US can even be part of your core portfolio, if you're investing in, let's say, in this fund or Hong Kong market or Taiwan market, think about it as uh, a satellite portfolio where you can take exposure, let's say, up to 5%, and if experience is good, you can talk about investing more. But that is how you should approach investing in US first, and then let's say graduate towards moving in other markets.
Right. Okay. So while we're talking about risks involved, can you shed some light on the risks involved in investing in the Eastern market?
Yeah, I think so. There's just simple add-ons, right? If you are investing in foreign markets, you are investing in an equity market or an economy which is affected by the regulatory risk, by the
Mm-hmm.
political risk. That is true for Hong Kong also, US also, right? If there's an action taken against Facebook or set of FANG giants, then it will affect Nasdaq and S&P 500 and a FANG plus also. So you get affected by that. You get exposure towards the currency. If let's say the currency you are investing in, or your asset is in, if it doesn't perform well, your value will go down. If it performs well, your value will go up. There are other set of risk, which is, let's say, operational risk or timing risk. Tracking risk typically higher, but I think if you have to say, majorly it is the regulatory risk, the political risk, geopolitical risk, and the currency risk, apart from the market risk, right? For example, if you are investing in, let's say, Vietnam or Indonesia or some markets like that, their market makeup will be different, right? For example,
Mm-hmm.
India, our market is majorly through banks, right? Banks dominate. BFSI segment dominate our market. If you look at US, tech dominate. So the behavior of US market because of tech can be different than what the behavior of Indian markets will be, because we are dominated by BFSI. So all these factors affect, and all these factors affect to a different extent, right? For example, I think one very beautiful example is that in COVID times, both Eastern tech companies and Western tech companies had same set of opportunities. They grabbed
Right.
onto that, but because of the regulatory headwinds, Hong Kong did perform well. There was a correction, and US has performed phenomenally.
Right. All right. So while we talk about that again, what are some sectors or industries investors should keep an eye on, and what are some I think with respect to Eastern markets itself, what are some industries they should avoid?
So, see, again, first of all, right now the go-to word is emerging and disruptive technologies, right?
Right.
As we talk about it, people talk about the fourth industrial revolution, which will
Mm-hmm.
happen because of these technology. We talk about artificial intelligence, we talk about robotics, we talk about cloud computing, Internet of Things, 5Gs, EVs,
Mm-hmm.
etc. And that is something which we believe, and as a group also, we believe that this is something which, from a thematic investing point of view, is going to be very interesting for investors. And for example, our group company in US, which goes by the name of Global X, it's one of the top AUM funds is lithium and battery tech. So just giving you a flavor that what is selling in global markets. It's just not simple plain vanilla indices. Themes are also increasingly forming part of the portfolio. Because if I have to ask you that which is one thing where you feel very having very good vibes about, or you feel that the prospects are very high, then you'll probably say EVs and autonomous vehicles, because we
For
see
sure.
gradually uh,
Hmm.
uh, us moving towards that, right? But having said that, one should be very conscious about investing in such themes, because valuation is also very important. Are you entering at the right time? Are all the potential growth opportunities already priced in? Am I getting exposure to just one set of this domain, or is my portfolio wide enough which is capturing companies not only uh, the entire domain of that technology, or but also multiple markets also? Because when we talk about EVs, you're talking about battery technologies, you're talking about lithium, you're talking about
Right.
the automobile manufacturer itself, you're talking about ancillaries, etc. So there's an ecosystem, and then probably it takes a more sorts of developed investor to first to then invest in thematic products. So I think for the viewers, if the first step should be just to get hanged by investing in plain vanilla international products. It can be through
Mm-hmm.
passive, which I feel should be the preferred way, and then move towards thematic when they have comfort of investing in international markets.
Okay, I think the next question is also perfectly aligned as to what percentage of funds should be allocated by any investor while investing abroad. So, how much of their portfolio should be there?
I think recently I myself have feel that, and is that there are a lot of opportunities globally, and we should not
Mm-hmm.
look at global markets from just taking, let's say, a very small portion of allocation. Like, should not, there are some products which can even become a core part of your portfolio. Like I said, S&P 500, S&P 500 top 50, these are
Mm-hmm.
products which consist of very well established companies, sector agnostic in nature. They can form part of a
Okay.
core portfolio also. Whereas products like Hang Seng Tech, or let's say something based on Taiwan market, or other markets, can form part of your satellite portfolio. I think as a total you can start with 5% allocation, but I think people can easily go up till 15-20% of their portfolio in international funds. But having said that, do assess your risk profile and then probably invest, because for example we have a FANG and S&P 500 top 50. Both have
Mm-hmm.
outperformed in Indian markets in last 3 5 uh, 10 years, but one carries lower risk, one carries higher risk. Higher risk has done well, so that's okay, but you should also look at volatility before you invest.
For sure. Okay, so the last question is the Chinese government is focusing on reducing their carbon emissions, which has impacted many industries such as metal, steel, real estate, etc. So, how much impact does this have on people who are invested in China?
Yeah, so I think if you look at Hang Seng, probably then that particular portfolio hasn't done well, and that is one reason why we are coming out with Hang Seng Tech. Right, we believe that
Mm-hmm.
tech as a whole, as an ecosystem, will perform well, while there are issues on the soft tech side. But we feel that even when that issues will dissipate, that segment will also probably recover from a pricing point of view. And then there's hard tech, which I've like talked about multiple times. In this portfolio, like that gentleman mentioned, we have exposure towards EVs, autonomous vehicles, towards other emerging technologies like cloud, 5G, etc., where the Chinese government is focusing on from an investment point of view. So I think, yeah, I think if you feel that way, probably you should invest in companies which, or segments which the government is promoting, like hard tech, etc.
Got it. All right. So these were the questions for you. So thank you so much for joining us today, and thank you for the audience for being so patient and asking such wonderful questions. Do check out these funds, and if you that is something that fits your risk appetite, please go ahead. You can go ahead and invest. And we will be back again next week with another interesting topic. So have a great weekend, and any parting words before you go.
Well, I think people who want to explore international markets, investing in markets other than US, can be a very good
Mhm.
diversification opportunities.
For
I
sure.
feel right now Hong Kong offers a very good valuation entry point as well. But having said that, I think we have talked about it multiple times that to assess your risk profile,
Right.
it is a more volatile market, and if it suits your risk appetite, then you can obviously gauge whether you want to invest in this portfolio or not.
Awesome. Fine. Thank you so much. And I will see you again next week. Bye bye.